Hi, everyone, and welcome to the second webcast from the Canary team. I am Sarah, and I am the co-founder and CEO of Canary. I'm here with Andre, who is one of our original co-founders and the guy who actually knows about finance. Today, we're going to be discussing unit economics and why they're so important for startups to know. Hi, Andre, how are you?
Hi, Sarah. I'm well. How are you?
I'm good, thanks. Good, thanks. It's a bit warm today, actually, but I'm doing okay.
Okay.
Maybe too warm to discuss unit economics. I'm not sure.
I want to discuss unit economics. Come on, it's a hot topic.
It's a hot topic. Oh, yes, that's a hot take.
That was great.
But thanks again for coming on. I guess it's a kind of a show we have going on now. One of the things that we hear a lot from our users and from fellow founders is that unit economics is this mythical thing that no one really understands and no one really learns about in school. So I want to have that conversation with you today about, what are unit economics from the basics, but also, how to use it and why they're so important, especially when you're fundraising,
Yep.
if you're up for that.
Yep, well.
Very excited.
Here.
You were told to be here. Good. So why don't you start just explaining what unit economics actually are?
Unit economics is it's the economics of a business distilled to like the unit, the core fundamental unit of that business, right? So for SaaS businesses, it's customers. For airlines, it could be seats sold or kilometers flown. For lawyers, it could be hours billed. But generally, when you read stuff about it online, it tends to be per customer.
Yeah, good. And so why are they so important?
Why are they so important? It's because it distills the core of a business into units, and the reason is there are a lot of early stage businesses that don't make money, and investors and stakeholders, they need to be able to assess whether this unprofitable business is going to make money at some point in the future. And I think, I'm not sure if it's true, but I read somewhere that the unit economics was developed back in the 90s by VCs because they had exactly that problem. Most of the businesses they were looking at least stage businesses, in a conventional P&L sense, were losing money. And so they wanted to figure out, okay, which one of these companies is going to make money in the future? And so they came up with the concept of unit economics.
Right. And what do they actually tell you? I mean, what would they tell an investor or a company?
Well, they'd look, there are two primary things, and then, there are probably 5 little drivers in unit economics, but there are 2 key things. So one of them is customer acquisition costs. So how much does it cost? We call it CAC, so customer acquisition costs. How much does it cost to, in terms of sales and marketing, to acquire a new customer? That's your CAC. And then lifetime value. So the lifetime value is how much money am I going to make over the lifespan of this customer's relationship with the firm. So within lifetime value, you've got a couple of other drivers. So you've got the revenue per unit or per customer. You've got the cost of developing the product that you're selling to that customer. And then you have to divide that by the lifespan of that customer, right? How long are they going to be there? Right. To do that, you use a concept called churn. So churn is just the number of if you're looking at monthly data, so churn is the number of customers you lose in a month. So if you lose 20% of customers in a month, that means the customer lifetime is 1 divided by that, so it's 5 months.
Got it. Yeah. Can you maybe put this into context a little bit, because we've been working on Canary's model and looking at our unit economics as well. Can you talk a little bit about how we've used that to make decisions, or at least assumptions and thoughts about how we run Canary and our business model?
Yeah, absolutely. Every business starts out with bad unit economics. That's just how it is. But the question is, how are you going to improve them over time? Yeah. And so we have that, and in fact, it's led to discussions at board level as well, because a lot of let's say older investors, or ones who don't have experience particularly with unit economics, they look at the EBITDA, they go, or EBITDA or profit and loss or net profit, sorry, and they say, okay, it's why are you not going faster here? Why do you not have enough customers at this point?
Right.
Whereas what we did when we were doing the modeling for Canary is we try to find product market fit. We're going towards that. The customer acquisition cost is obviously going to go up in the in the early stages, as you're entering new markets or whatever, you're trying to attract customers, and then the lifetime value before you start generating revenue. The lifetime value of any customer it's going to be, it's going to be infinite, and then it comes down, and anyway, so it's all very convoluted and complicated at the beginning. And I mean, it leads into other discussions around some of the key ratios that we've been looking at for unit economics. But there are definite points. Unit economics, the great benefit is it shows you the moments when you need to slow it down and not burn as much cash, and moments where you need to just go for it.
Right. And so coming back to that discussion, we had in our board where, I mean, how we maybe didn't handle it as well as we could have, but how would you have handled it if we could have handled it better? That discussion about, are we looking at balance sheet and P&L and break even, or are we optimizing for unit economics?
I mean,
what's the ideal conversation to have, and how do you convince your board to look at the right things?
Yeah, it's tricky. Sorry, I was hearing the kids. I can hear them, and I'm worried that they're just going to, anyway. But if they come in, we'll ask them.
Yeah.
It is tricky. I'm not going to say it's easy with investors who haven't been exposed to it, but it's you need to articulate and you need to explain why it is that you're focusing on that. I mean, it's the same with any other KPI that could be important to your business. They need to understand why, and most rational investors, they will. If you can explain why you're assuming this or why you're looking at a particular KPI, they'll. So again, it's knowing what your unit economics are and being able to explain them.
Yeah. And I think there's also a big difference from, if you work with, or if you're raising investment from high net worth or angels, that might be, of a different generation, as to if you go and pitch to maybe a venture fund or, maybe startup founders that have just exited a business who've been through that whole thing. And then the conversation will always be focused around unit economics, in my experience as well.
Absolutely.
So what would you, if I go to an investor meeting and the investor, the VC will say, can you walk me through your unit economics? Like what is he or she asking me really? And what would be your approach to going through those?
So, I mean, we already talked about it. You need to know your customer acquisition cost. You need to know your revenue per, let's just assume the unit is customers, right? So you need to know your revenue per customer, the cost of goods sold to that customer, and your churn rate, right? If you know those things, then you can discuss everything around that. But the other thing they're looking for, some of the key ratios that you can create using lifetime value, so LTV, and customer acquisition costs and CAC, right? So if you look just at CAC, and then so if you do 1 over CAC, so 1 divided by CAC, it tells you the number of months to get that payback. It's called the CAC payback, right? So, and that's a measure of your cash burn per unit per customer. So generally speaking, if you want to, so the higher the CAC payback, the more money you're going to need to raise to finance your business, right? So you want to have the shortest CAC payback possible. Generally, investors look at less than 12 months payback, because that's the standard fundraising cycle. Just knowing that you're not going to burn through all your money, in that period. So that's the CAC payback.
Can we pause on that? So if I have a really long CAC payback now, how would I go about optimizing my CAC payback?
Yeah, you need to then start testing different channels. You need to scale back on, either you need to find a method of acquiring more customers for the same cost, or you need to lower the costs and still maintain the same number of customers. So that's basically sales and marketing focus.
Yeah. Okay. But if I lower my costs, that there are some interdependencies that you have to be aware of, right? You can't just go and change numbers.
That's right. I mean, as an example, right? So if I, the most direct influence on profit is price, right? So say I raise my price, that increases my revenue per customer. And then you think, great, my lifetime value's gone up, but if you increase your price, your churn is going to go up as well. So so your churn goes up, that means your lifetime value goes down. So there's an indeterminate impact. Similarly, if you enter a new market, you think, oh great, I'm going to sell more units or whatever, or I'm going to my lifetime value is going to go up for whatever reason. However, your CAC is also going to go up because you're going to have to spend more acquiring these new customers. So there's an interdependency there that you need to think about when you're doing the modeling.
Yeah. Okay, good. And the other element in terms of, you said CAC payback, and what's the other thing?
Okay. So the other one is lifetime value to CAC, right? So LTV to CAC ratio. And so if you divide one by the other, as an example, if it's 1-to-1, right? So that means if the amount of money that I spend on so the gross profit that I get from that customer or that unit only just covers the cost of acquiring that unit. Okay, that means your unit economics will be flat, right? That's flat effectively. And some people go, oh, well, that's okay. At least I'm not losing money. But there are other expenses in the company, right? So you've got everything else, all the operating expenses and rent or whatever it is, stationery. No one uses stationery anymore, but stationery, those sorts of things. And so investors are looking for, as a rule of thumb, an LTV to CAC ratio of at least 3. And the reason is, so not only does the gross profit that you make from this customer over the lifetime of the relationship, not only does that exceed the costs of getting that customer, but it also leaves you with extra money to pay off all of these other expenses. And so an investor will look at that and go, okay, they've got a great LTV to CAC ratio. That means if we invest in them now and they start ramping up, then they will very quickly, if they're not already making money at a bottom line level in a traditional economic sense, accounting sense, they will very, very quickly turn it around and make a lot of money.
Right. Okay. And so how do you go about optimizing the LTV CAC ratio?
Okay, well, I mean, you look at the components of them. So you could, but again, you got to remember, keeping in mind that everything's interdependent. So it's the same way that I would advise a client on, going through and improving their cash flows or the valuation for a sale of the company. So you look at the components of LTV. You've got ARPU, so average revenue per user, which is revenue times price. Sorry, price times revenue, price times quantity, right? So there you can think about increasing your price or lowering your price, and then price has an impact on quantities as well, right? Quantity sold. Then you've got the cost of goods sold. So that's customer success team, that's hosting fees, any third-party stuff that's in the product that you're selling, those sorts of things. You look for economies there. And then underneath that, you've got your churn ratio, right? So these are all components of the lifetime value. So your churn ratio. So how do you minimize, how do you reduce that? That's, again, if you want to reduce your churn ratio, you may have to improve your customer success team, but that increases your COGS, that's interdependent. So how do you retain the customers? And then with CAC, I mean, it's what we talked about. It's sales and marketing expense. How do you get the most out of that team? And attract customers for the lowest possible cost. So those are the issues. Those are the drivers you need to look at.
Right. Yeah. And so we've been discussing this because I was confused in the beginning about COGS and cost of sales. Are they the same thing? What's the difference, and how do we actually?
They're the same thing. COGS is cost of goods sold. So it's for it's a company that makes a physical product. And cost of sales is usually for a software business, but it's a holdover. Like you'll see COGS for a SaaS business as well. It's just tradition.
Got it. It's quite a complicated aspect, and not a lot of founders are used to working with this. And I think what we've seen is that either companies forget to include them in the model, or they on purpose leave them out. Could you talk a little bit more about how, as a founder or as a startup, you can use unit economics in sort of a management strategic decision-making process? Or
I mean,
how do you actually use them?
I mean, even not just for founders. I'd say that large companies as well, organizations could use this, even for subdivisions or whatever. But you look at those two ratios we talked about, the CAC payback, and then also the LTV to CAC ratio. So the CAC payback tells you how much money am I burning, right? So if your CAC payback is long, so 2 years or whatever, you do not want to be accelerating or trying to accelerate the growth of your business at that point, because it just means you're going to be burning a lot more money, right? So you need to focus on shortening the CAC payback before you accelerate, right? And similarly, I remember reading an analogy online about the LTV to CAC ratio, and so someone said, oh, it's like a slot machine. So the LTV to CAC ratio tells you if you put $1 in at the top, it tells you how much are you going to get out at the bottom, right? So if you put in if it's 3 to 1, if you put in $1 at the top, you'll sorry, a pound. We're in the UK. If you put a pound, and then you get £3 back. And if you're not getting at least £3 back, then you need to spend time tuning the machine, which in hindsight probably sounds like we're rigging slot machines. So how about we don't? It tells you like in a car, it tells you when to accelerate or when to slam on the brakes, right? So if your payback is long, you need to slow it down and work on improving that. If your LTV to CAC ratio is not there yet, then you need to work on tuning the elements of it. And then, but the big thing. So this is why it's so helpful for CEOs. It gives you the right timing. It tells you when to really slam on the accelerator. To mix heaps of metaphors together with slot machines.
Football metaphor as well.
Maybe cricket as well. But it tells you when to slam on the accelerator. So if your LTV to CAC ratio is 3, 4, 5, you need to go for it. That's the opportunity. Assuming you've got a big enough opportunity, you need to get as much market share as possible when your unit economics look that good. If your LTV to CAC ratio is 20 or more, you have waited too long. Right, so there's a balance between there. If it's below 3, you should not be thinking about scaling. So those are the rules of thumb that helps founders figure out when they need to raise money or what they need to do.
Yeah, and do unit economics change over time? Is that kind of
absolutely?
Is that how you work with them?
Even in our modeling for Canary, it's it starts out looking awful, and beyond awful, because your customer acquisition cost is massive. You're not making any revenue. You've still got the cogs in there. Your churn, especially even when you start, your churn is going to be high. So unit economics look awful at the beginning, but when you start heading towards product market fit, then all of those things start improving. You found your pricing model, so your ARPU might be right. You're refining your customer success team, or your whatever it is, the hosting those costs are settling in. The churn, you've figured out what it is that's going to help you retain customers. So the LTV starts stabilizing, and your customer acquisition costs is also stabilized as well. So things will start looking better. And then as you scale up, and then you develop things, you improve processes, then your unit economics look really, really good. And that's the point. You raise money, quite a lot of money, and then you scale rapidly. But then, as is always the case, competitors will enter the market, and then that will mean your CAC goes up again. And so there's a sort of a ramp up, and then an improvement, and then another, not a ramp up to the previous highs, but it's sort of it's like an M-shaped curve.
Yeah. I remember you told us the case study on HubSpot, in terms of CAC and how they've sort of not disregarded, but at least they're looking much more at sort of land grab strategies. Can you elaborate a little bit on that and what that means, or what that would mean for a business?
I can't remember that case study. That sounds really fascinating. Could you dig it out for me?
I remember. Okay, next question.
I know. Conversation over. I remember. I did if you recall, I did a unit economics course. A course for some founders. I don't remember. I remember I vaguely recall there was an Amazon Prime case study as well. I tell you what, we do another one.
Tell me that one.
I recall there was one. I don't remember what the details were.
Sorry, I sprung that on you. Yeah. It's very vivid in my mind. No, I think that the whole point of the HubSpot was just that they have a strategy to be, the market leader. And so they spend a lot to acquire customers and getting them on board at a fairly low ARPU. So their CAC is high, but then as people get on board, obviously their ARPU for that, or I guess not their ARPU, but revenue per customer it goes up.
Right.
Yeah, so they have a strategy about having a high CAC because they want to be the market leader.
That sounds really interesting. I want to read more about that.
That's what I remember. Maybe it's just in my head. Okay. We might have to cut this out. We'll see.
Oh, I like that.
Unit economics are fun. Okay, I guess maybe we need to round it off. Completely crazy, but if you have one thing that founders should remember about unit economics, what would that be?
That you need to know them. So when you go to an investor meeting, I mean, if it's like we said, if it's a VC, they're going to ask you what are unit economics, and if you can explain all your numbers, those key numbers we talked about, so the ARPU, the COGS, the churn rate, the CAC, if you can explain all of them and why, it comes back to the financial modeling discussion we had, right? So you make certain assumptions. If you can explain the assumptions behind all those key drivers of unit economics, and also how you're going to improve them over time, it will lead to a great discussion with these investors, and they'll really think that you know the ins and outs and the drivers of your business. So it's in good stead. Yeah,
good. Is there anything else that we need to cover on the basics of unit economics that you remember?
that I remember. Yeah, that's the key. That's the key point here. No, I think if you remember the key drivers, the key points of unit economics, remember the two main ratios, that already is a great start for any founder. And understanding that it's not going to be great at the beginning, and it'll get better. Those are the key things.
Great. And of course, I have to make a little plug for Canary, because obviously we calculate unit economics automatically, and with the next few months, we will also be able or enable founders to actually play around with their unit economics and see how that affects various sides to the business. And we build in all of the rules of thumb that you've just gone through actually in the product. So if you're way off, we will sort of give you a little notification to keep an eye on that at least. So really so if anyone, I think so. It's one of those elements of finance that not a lot of people grasp before they sort of really work with it. So I'm excited to see that in action.
Excellent.
Good. If any of the viewers have any ideas or suggestions for topics that we should cover, then please let us know. You can still sign up to the waiting list to access our beta as well.